Hello everyone, welcome back to another video. Today we're going to be talking about letters of intent in the M&A process. And just as a quick background, I'm a Canadian investment banker focused on the lower middle market space, primarily selling businesses in the $2 to $50 million enterprise value range. So really this video is geared towards both buyers and sellers going through an M&A process and looking to prepare and or review a letter of intent. So let's jump into it. So a letter of intent is a formal offer submitted by a buyer, which specifies really the terms of the purchase. And really, this is the final offer that you would receive and be expected to sign back as the seller. So really, the key binding term within a letter of intent is that once you sign that offer and you agree to the terms that are in that offer, you then go exclusive with that buyer and you cannot negotiate with any other buyers that may be interested in your business. And so typically that exclusivity period is anywhere from about 90 to 120 days. And so even though the purchase of the business is still non-binding because it's just a preliminary offer, what the seller does is they commit to working with that buyer on an exclusive basis. Now, the challenge with a letter of intent is that usually from the seller's point of view, all the negotiation, the effort, the focus goes into negotiating that document. So mentally, the moment that offer is signed up, they lock into the fact that, okay, we've agreed to the deal. Now it's just the formality of getting the deal closed and let's just go through that process. And so they underestimate the amount of work that's involved post LOI. In general, for most first-time sellers, I see that to be the case. And so from the buyer's point of view, when you're actually putting in an LOI, it's absolutely critical that you manage the seller's expectations and be detailed upfront in putting all the major terms of the deal in that letter of intent, but at the same time, managing the expectations of the sellers to be that there is more work to come. So this video, I'm going to be walking through what an LOI looks like, walking through a template, as well as really digging into the best practices and some of the common mistakes to avoid when submitting an LOI. And as well, if you're interested in actually looking at a live template, you can go on our website and actually purchase one of our LOI templates. We have one both for the share purchase agreement and one for an asset deal, which are two different templates. And just quickly, as a quick disclaimer, obviously, I'm not a lawyer. I'm an M&A advisor. I'm here to just share some best practices. Before you submit any sort of LOI, you should consult someone that is an M&A lawyer and that can help you through that process. Okay, so let's jump into the common mistakes. So the first one, and I mentioned this in a lot of different videos, very important that you avoid a short LOI just to get a deal done. A lot of buyers oftentimes, they get on a call or they meet a seller and they really want to quickly get that seller exclusive with them and get them locked up. Naturally, you feel competitive, especially if it's a deal that you want. You want to make sure that that seller doesn't get interrupted by any other buyer and starts losing focus on you. The challenge is there's a balancing act between moving too quickly to getting them locked up and not having substantive discussions around the key building blocks of that deal. So, oftentimes some of the deals that we see fail or where there's stuff that comes up in closing that ultimately results in that deal falling apart is in the front end, that LOI was very short, 1, 2, maybe 3 pages. In general, our LOIs, and you can go on our website to see that template, are usually 6 to 9 pages long, and they go into a lot more detail. And the reason being, again, the seller is mentally negotiating and investing a lot of the energy now. They're not thinking about all the other things that have to fall into place on the closing process because they don't really appreciate how hard it is on the back end. So what you need to do as a buyer is spend enough time to really agree to all the key building blocks so there's no hiccups along the way post LOI when the seller may feel like you're pulling new terms up on them that they've never heard before. You just want to get into that position. The second one is deposits. Certain sellers either have gotten bad advice or have read online that LOIs have to come with a deposit. In my years of doing this, I've never seen a deposit, both on the banking side and on the sell side, M&A side. So really, deposits are not expected. The very rare situation where there is some sort of deposit-like protection is where there may be a break penalty, meaning, say for example, you sign an LOI, you decide to go down the process of due diligence, and the buyer, you start to incur the cost associated with accounting fees, with legal fees, with diligence costs, and all of a sudden, some external factor results in that deal falling apart. Well, in that situation, to price in the risk of that external factor, be it regulatory approval, customer consents, whatever the situation is, to recoup some of those fees that you incurred in doing the due diligence up to that point, maybe you can negotiate a break penalty. And I've worked on about 50 deals in the last couple of years, and I've only seen a break penalty in one deal, where it was an international buyer. There was some cross-border complexities, as well as it was a public company buying a private company, and we were concerned that they may not be able to close that transaction, and therefore the seller got a break penalty because we were unsure about the buyer's ability to close, and so we were able to recoup some fees in that transaction. because ultimately it did not close, unfortunately. Now, another one is exclusivity. And usually with exclusivity, there's two mistakes that we see. Either one, there is no exclusivity mentioned in the offer, and or it's not well defined and very light in terms of its definition. And so it's very important when you are submitting an offer that you clearly defined there's a term to the exclusivity period of whether it be at 90 to 120 days, or what does that mean? What does exclusivity mean? It doesn't just mean that you stop discussions with other buyers. It also means that you're not communicating with them at all, meaning there's no real back and forth communication when it comes to any deal, the transaction itself. Now, the second mistake we see is that sometimes the exclusivity period is too long. A buyer will come in and say, no, I need 6 months. I need, I've even seen abnormally 9 months of exclusivity. Well, that's not really market and is unfair from the seller's point of view. So really, the kind of market standard of 3 to 4 months is what is expected and should be clearly defined in the offer. Now, another mistake, and this is one for buyers in particular, is oftentimes first-time sellers don't really understand the M&A stuff. So our recommendation is that you always try to over-communicate and try to simplify your language. If you're an MBA and you've studied this and you ETA and entrepreneurship through acquisition, and this is the exciting new frontier, and you're whipping out all these terms about EBITDA and covenants and leverage and all that kind of stuff, just remember that for that business owner that founded that business, has been in that business for 40 years, maybe has only a high school education, they may not understand a lot of the technical M&A terms that are being thrown at them, and will most likely when they look at that detailed LOI, be overwhelmed by the detail. So our recommendation is, just put yourself in their shoes and help them understand the offer that you're putting in front of them. And, sometimes we even suggest, recommend that they bring in an M&A lawyer, someone that they can feel is on their side of the table, so they can clearly talk to that person and say, okay, is this good? Is this bad? Like, what's market? What's not market? Because maybe they'll trust you as the buyer, but sometimes they may not trust you as the buyer. So who can you bring into that process that knows M&A is not going to be an enemy, but more of someone that can get that process moving along? And oftentimes it's that M&A lawyer that we recommend you bring in. But some of the situations I've seen in the past are, an LOI is put in front of a seller. The seller looks at the seller note, for example, and the VTB and says, okay, yeah, I have to hold back a certain amount of money, $2 million or whatever, for the next 3 years, and then I'll get paid in full after the 3-year term. So they conceptually understand the concept of seller financing, but they don't understand the actual legal side of seller financing, meaning that there is a subordinated and postponed security interest that note has on that business, and that it is not in a senior position above your bank financing as a business buyer. And so that's a very common one where sellers, they go down the process, and even though they signed that offer and may have agreed to set those terms, their lawyer is going to explain to them, no. The buyer's putting in $4 million ahead of you. You're behind the $4 million. Oh, and also the bank has full and complete control over when you get paid on that note. So you've turned over all control of that money to the bank. Are you okay with that? Naturally, they're going to not be okay with that. So, just allowing them to react to that, make sense of that, talk to people. I find that, that if you can avoid that reaction and that coming of Jesus moment that happens 30 days prior to closing, there's less hiccups in the closing process because you've engaged in that conversation early on and we're very upfront. So really, a best practice would be when you do have seller financing, really sitting down and saying, hey, listen, John or Joanne or whatever, let me explain to you how the seller financing works. Typically, I'm going to put in X amount of dollars in equity. The bank is going to give me another $4 million. And here in this offer, there's a $2 million seller financing. You're going to get paid to wait. There's going to be interest on it. But at the same time, the bank is going to want to be in a first position because the bank always comes first. And you're going to be behind that. But just so you understand, here's kind of the leverage that we're putting on. There's more than enough buffer if things kind of slow down. I'm very confident in being able to pay back that note. So don't worry about that. But this is just market standard. And I would recommend that you contact a lawyer and just confirm what I'm saying is the truth. And make sure that you're comfortable with that. And I can tell you that sellers are very appreciative when you're upfront with them versus they have to come to that realization by themselves. And then all of a sudden, in their mind, they're thinking, the buyer never mentioned that to me. Were they trying to pull one on me? Were they trying to hide this from me? The sellers react in very weird ways when they find something out later on in the process as they're going through the process of letting go of their baby. So better to be upfront than not. Now, another mistake is waiting for 100% of the info. This is a big one for first-time business buyers, especially in SME transactions. The information may not be there. I would say in the vast majority of our transactions, you're not going to have all the information to make that 100% complete decision. The reality is the LOI is another step in the process of buying a business. And so similar to an EOI, which comes before an LOI and is really more of that kind of 1 or 2 page preliminary offer just to make sure that you're on the same page. Once you get to the LOI, there's a little bit more information. You've toured the business, you've met with the management team, you have a better sense of the opportunity, but maybe you have 70% of what you need to really buy this business. Remember, you're not going to get to 100% until in closing, and maybe not even in closing. And most of these smaller businesses, they can't produce some of the information you need. So you may just need to close this transaction with 90% of what you need. So really being overly cautious and analysis paralysis is a common condition that I see with first-time business buyers, where they're worried about getting every single little bit of piece of information to put in that offer. The reality is you're shooting yourself in the foot, because from the seller's point of view, you look indecisive. You don't seem like you are in control of the situation. And at the same time, you now risk the seller looking to other buyers or moving with other buyers when you can be that definitive, quicker buyer to the table. So it's a balancing act, because funny enough, the first mistake I said is you kind of don't want to go too fast and lock them up with a very light offer. But at the same time, you have to put in enough detail in that offer with probably 60 or 70% of the information that's been given to you. So there is a bit of that again, assume that it's correct. Assume that, that information that's been given to you is right, but then on the back end, you have to confirm. Okay? So there is a bit of that trust, but confirm approach to these transactions. And then the last one, and this is more of an ethics thing, especially when you're dealing with M&A brokers, but if you're a business buyer and you have multiple LOIs out on businesses, just be careful, because I know that you want to mitigate your risk and make sure you're looking at different deals, but just be careful that if you're in a situation where you have multiple signed LOIs, be very clear that you're going to pick one and move with just one. I've dealt with 1 or 2 buyers in the past where they've had multiple signed LOIs, and through that entire process, they were half-assing the close. They were 1 foot in, 1 foot out, because they had another deal on the other side that they were constantly comparing to. And so from our point of view as a sell-side team and as a seller, you're not really committed to closing that transaction, and therefore, that gives us a lot of uncertainty and also creates a lot of distrust in the closing process, whereas really what you should be doing in the closing process is leaning into it, learning the business, spending more time with the seller, building that relationship, rather than juggling 2 different kids. So kind of likening your deals to your kids, you kind of can't pick both. At the end of the day, if you're going to choose to raise 1 kid and work with 1 kid, which is that child that you're going to pick? So obviously from a sourcing and business buying point of view, it's okay putting out LOIs, but if 2 are signed back at the same time, make sure that you withdraw from one process and pick one that you're going to work with instead of managing 2 or more. Now, best practices. So really the first thing I always recommend, and you'll see this in our template when we walk through in the back end of the video, is that I always recommend that you define how you arrive to the valuation. Instead of just putting a number and saying, well, I value this business at $5 million and here's how I'm going to pay you. It's better to say, I value this business at $5 million. Here's the benchmark that I used, and here's the multiple that I use to get to that valuation. And the reason being, if there's ever a situation where the business starts to trend down, when performance changes substantially, instead of you all of a sudden saying, well, it was just a number that we picked out of the air, you've clearly communicated to the seller up front how your valuation methodology was, and therefore you can revisit the EBITDA benchmark if, say, for example, EBITDA starts to decline. And in this situation, if, say, for example, you needed to retrade, well, now you just say, hey, listen, John, I assume that your EBITDA benchmark was $1 million because that's what you did for the last 3 years. We're now in closing. It's at $750,000. I still want to close this deal because I'm 30 days away. But the reality is, I thought this was going to be $1 million EBITDA business, and it's only $750,000. So the multiple that I gave you of 5 times, I'm not changing that. I still believe this is a 5 times business, but today this business is doing $750,000. So I'm going to reset the EBITDA benchmark to this, and this is why the price that I'm reproposing to you, that I'm retrading you at, this is how I arrived at that number. And that way, there's less of a defense from the seller's point of view to say, oh, you're just pulling a fast one on me. Like, oh, how do you know that it's less than that? Well, no. Here you've broken down your valuation and it's clearly communicated to the buyer. Okay. So, and then the next one is defining milestones and key deliverables. So in that LOI offer, you're going to see there's a conditions of closing section, and there's also a exclusivity and timeline breakdown. I always recommend that for first-time sellers in particular, they need to understand well, what is coming down the pipeline? Yes, we agree to the high level terms. Now I have to confirm and verify the information that you've given to me, but what does that actually look like? Sometimes it's a bit of a black box, and especially for first time buyers who don't know that process as well, it's kind of like both the seller and the buyer are figuring it out as they go. And so there's a lot of like this, blurriness around, well, what deliverables do I have to focus on? What does the timeline look like? And naturally the seller's going to get angsty. They're going to look at that and say, well, are we making any progress? It's been 30 days. What about 45 days? Where are we at? And so a good way to manage their expectations is actually to spell out key deliverables, to say, well, when am I going to complete my QOV, my quality of earnings? When am I going to confirm the bank financing? When should you expect that I get that confirmation? When do I want to meet with customers and suppliers to verify the credibility of those key relationships? When do I want key employees to sign on to management contracts and therefore talk to key employees about this potential sale? And then when do we want to target the signing of the legal documents versus the closing of the legal documents? Because sometimes you can sign the legal documents and close on the same day, but there are other transactions where you actually sign the legal documents, get everything papered up, and then you have an interim closing period where you then go and talk to customers and suppliers and employees and let them know about the sale, but allow the buyer to verify the final bits and details before they actually close that transaction. So it depends, but ultimately what you want to do is you want to lay out your plan of diligence so that the seller clearly understands that, and when they start getting a little bit restless or they feel like there's progress that's not being made, revisit the core plan and say, no, we're on track, or we're not on track, but it's because we got delayed here because of X, Y, and Z. So it's better to have that spelled out, and it seems like you're in a lot more control as the buyer. And then another one, and I've mentioned this on the mistake side, is the whole over communication. So again, a lot of the reasons why these deals fall apart or there are situations that arise post-close results in a lack of communication, results in poor expectations management, and results in usually just either one side is unrealistic, be it the seller or be it the buyer. But the best way to realize whether both sides are realistic or not is to communicate, is to really make sure that you're constantly keeping in touch. So the first thing is you really want to make sure that throughout the closing process, once you've signed the LOI, that you're regularly communicating with the seller. So you want to sit down maybe on a weekly basis and just touch base and see, well, what's going on? Communicate the progress that you've made as the business buyer so that you're showing the seller that even though you may not be seeing a lot from your side of the table, I'm doing a lot of work on my end. Just give me time. And so you want to make sure that you have that regular communication rather than once every month. Try to do that once a week. And that also gives you the ability to build more trust and have a better relationship with the seller if there is something that's going to come up that's going to compromise or put pressure on that relationship. Another thing is really important is from an email point of view, you want to make sure that emails are either clearly communicated, but also you want to avoid any negative feedback in those emails, because typically negative feedback gets interpreted in a more significant way when written. Whereas if you have a call with someone and you want to give them negative feedback, that's a better approach, especially for sellers that are going through a very emotional time selling their business. So typically, whenever you have these changes or key milestones, you want to make sure that you document it, you put it in an email, and you try to over communicate, but also avoid any negative feedback in those communications. Okay? So another one, and we already mentioned this before, is from my point of view, certain buyers feel like, well, I want to deal directly with the seller and get the deal done before they bring anyone else to the table to muddy the waters. I think that's such a backwards mentality, because it's unavoidable that you're going to see that seller retain an M&A lawyer in the process. So why shouldn't they retain that M&A lawyer up front when you're actually negotiating the offer? And not only that, but you have now influence over who they are going to retain on the legal side. Because one of the challenges we find is that sometimes the seller is not sophisticated enough to realize that there is an M&A specialized lawyer that they need to use for the transaction. And we strongly advise that they use M&A lawyers, but sometimes they'll retain their buddy, who's just a general commercial real estate lawyer. And so that person is either not sophisticated enough or has a different approach to M&A transactions, which creates conflict. So from your point of view as the buyer, you should actually encourage that seller to engage with an M&A lawyer and make recommendations and reiterate the concept that no, there's a difference between general business commercial lawyers and M&A lawyers. Make sure you have someone, and if you don't, I'm more than happy to give you 3 different names for you to interview yourself. And certain sellers will take you up on that because they obviously don't have anyone in their network that does M&A. And other sellers won't take you up on that offer for the introductions, but at least they have in the back of their mind that you warn them to not retain a non-M&A lawyer. And that will save you a lot of heartache in the closing process. Another one, very obvious, but very, very important, is never lie or deceive the seller. And sometimes, we don't get involved with it, but I hear a lot of stories where some buyers try to take that fake it till you make it approach. They're, oh, well, I have all this money behind me. I have all this, management strength, and I got these people that are going to help me. Yeah, we're going to close in 30 days. Yeah, we're going to close. Oh, we're super quick. I've closed 50 deals. And maybe there's not, that's not the truth. Maybe they're embellishing it a little bit, or maybe they've worked on a team that's done 50 deals, but it's not them that's done the 50 deals. To be honest, most of these sellers are going through this process for the first time. They don't know that you don't know what you don't know. So don't try to over embellish yourself, because ultimately they're advisors, or they will eventually come to realize that, hold on a second, this guy's kind of lying about what he's going to do. He's not really that in control. It's better to actually approach it as, hey, listen, I'm buying the business for the first time. I have a team, you have a team. Let's just figure this out. Like, I'm here to listen and learn. If you have any suggestions, or your team has any suggestions, I'm more than open to it. That egoless approach typically curries a lot more favor between you and the seller, and allows you to overcome challenges more quickly than if you're all of a sudden this perceived M&A expert. And, I've done so many different transactions, and I'm very wealthy and all this kind of stuff. And when challenges happen, and all of a sudden you start to push back and say, oh, well, the bank financing is not available, the seller's going to be like, well, hold on a second. I thought you were wealthy. Like, you could just write a check for this. Why are you worried about bank financing? So, it's important to really kind of manage the seller's expectations and try not to deceive them in terms of your financial and or management capabilities. And then the last one is expiring and bully offers. And so just let me define it first. A bully offer is really where is a strategy where the buyer submits an expiring offer. So they put in an offer, and it's clearly spelled out that, oh, by the way, like, it's a great offer, but you have 5 days to accept it. And you do this usually to either when you're working with a seller direct, and you really want to just get that deal locked up before that seller engages with any other buyers. You could also do it in a situation where there's an auction, and you're dealing with a broker, and you start to read the situation and realize, hold on a second, either this is a really, really good deal, it's going to be super hot, and you know what, I'm going to cut out your work, and I'm going to put in an offer right now at your asking price. Take it off the market right away, so I don't have to deal with an auction that may bump up the premium required to get this deal closed. On the flip side, you could also come into a brokered situation where the broker is not running a good process, is not in a strong position. They don't have multiple groups at the table. So you come in and you say, I'll give you an offer, but you give them an offer at a discount with an expiring option. And that way you put pressure on them to accept maybe something that's a little bit lower than what they want, but at least it's an offer, and they don't want to lose that offer, especially if they don't have any offers at the table. So there's a couple strategies that you can implement with bully offers, but I would say in the vast majority of cases, I don't see bully offers simply because it creates a lot of tension between you and the broker. And so if you have a really good relationship with the broker, that's a really negative way to approach that relationship. And as well, you have to really make sure that if they meet your bluff, that you're going to walk away. Because, if you have a really good deal, say, for example, and you're dealing in a brokered situation, and you really want to cut that process off and try to get in front of that deal and own it right away. Now, if you do that and that broker says, you know what, I'm going to take my chances and figure it out myself, well, either you stay in and now you've completely blown your cover on the bully offer and shown how much you really want the business, or you have to walk away from a really good deal. So it's not very common that we see bully offers, but in certain situations it's relevant. And definitely when you read the search fund type books, there a lot of the direct offer approaches recommend that you come in and you put an expiring offer. My thinking on that is, well, for first-time sellers, that's a lot to process. And then to also put them under the gun, I feel like it mistreats them. I know that, from the buyer's point of view, you want to move it along and make sure that they're serious or not. But I think you can get more than enough clarity in terms of your interactions with them. But if they start dragging their feet and you've had 6 months worth of conversations and you've actually finally put in an offer and said, hey, listen, John, I have to move on. Either you like my offer and you want to work with me or not, then that's probably where you can put in an expiring condition into that offer. So it all depends on the situation, but definitely not unreasonable in certain cases. Okay? So these are the final 2 slides, and then what we're going to do is we're going to actually jump into the LOI template, and I'm going to walk you through these, in more detail. But at a very high level, when you think about an LOI, there are a couple key sections within the LOI document. The first one is, well, who's buying what? Who are the purchasing parties? What are their names? What is the entity that they're using to buy? And what are they buying? Are they buying assets and or shares? And then as well, is there anything that's excluded? Be it personal assets, any IP assets that the seller wants to hold on to and maybe try to build separately, whatever the case is. So you really want to clearly define who is buying what and what is included and what is excluded and how is that being bought, whether it is shares or assets, okay? And again, this is something that I didn't mention in the mistake section, but sometimes I've seen offers from buyers where they submit an offer and it's like, well, I'm going to buy $5 million of this business. I'm going to buy 100% of it. but they don't clearly define whether it's an asset or a share deal. It's like, oh, well, we're open to both. Well, that's not really an answer. Either it's a share deal or an asset deal, because from the seller's point of view, there's substantial tax differences. And so it's not the same offer if it's $5 million in shares versus $5 million in assets. It's better to be very specific and to be upfront when it comes to submitting an offer. Now, the other one, I mentioned this in the best practices, is communicating the key financial assumptions. So clearly specify what the price is, and how did you arrive to that price in terms of valuation methodology? What is the valuation multiple? What is the EBITDA benchmark that you used? And then as well, how is that purchase price? What is included in that purchase price? Is it, working capital? Does it include working capital, or is working capital on top of the price that you're submitting? And is it cash-free, debt-free? And in general, for most of our transactions, I would say the price includes working capital, a normal level of working capital, and as well, it is cash-free, debt-free, with the normal level of working capital left behind, and the equipment assets left behind included in the price. Okay, so that's the very standard one. Sometimes in certain situations, the seller wants to see that the buyer is separately buying the working capital to feel like they've gotten paid for their working capital. So what you could do maybe in that situation is actually lower the price on the business purchase. And so you set the goodwill value lower, but then you separately price the working capital, that you put that on top. And so net, it's the same, but the way you present it to the seller, it may seem different. Okay. Now, the next point is, how are you paying the price? And there's typically 5 different forms of payment. There's cash on close. There's the holdback or the escrow amount. So it's cash that's being put back into escrow or being held back until certain conditions are met. Typically, it's 6 to 12 months or until we negotiate the working capital target. The third is the seller note or the vendor note, which is really a fixed loan between the buyer and the seller, where the seller is owed X amount of dollars. They have a charge on the business, they get an interest rate, and they get amortization, no different than bank financing, but subordinated to bank financing. The fourth is the seller reinvests a portion of the value in stock in that company again. So it's reinvested and or rolled equity. And then the fifth is an earnout, where it's more contingent and performance-based, where essentially you're saying, well, I'm going to buy this $1 million EBITDA business for 5 times, but one turn of that valuation, or $1 million, is going to be held back so long as this business continues to deliver $1 million in EBITDA over the next 3 years. I will then pay that money out to confirm that, yes, the business did continue to deliver what I expected to buy it off of. Okay, so it all depends on the type of structure and the market dynamics in that situation. But these are the 5 core forms of payment. And so it's very important that not only you list out the forms of payment and what value is allocated to what, but what are the underlying security and or considerations for those types of payment. And so we'll get into that. The other one is conditions of closing. So very important to define, well, what do I need to get this done? Regulatory approvals. I need to complete my due diligence on the Q of V. I need to make sure that I have any key contracts and or key employees to sign on to agreements to agree to the transition. You need to make sure that there's no material adverse change in the business and that all the legal documents are executed. So all these are very common conditions of closing that you would include in your offer to clearly specify that, yes, once these things are met, I'm comfortable in closing the transaction. But if one of them are not met, say, for example, there is a material adverse change in the performance of the business or in the performance of the economy, you now have an out to say, even though I still want to buy your business, the reality is one of my conditions was not met, so I have an option to just walk away now. So very important that you should include conditions of closing in your offer. The other is due diligence considerations and timeline. So I already mentioned this in the best practices section, but it's really important to define, well, what do you need? So if there's a Q of V, if there's the bank financing report, if there's a condition report for the building, if there's an environmental report, whatever the key milestones are on due diligence, make sure that you spell them out and set rough approximate timelines. It could be, well, in the first 30 days, I'm going to focus on my Q of V. On the next 30 days, I'm going to focus on the real estate once the Q of V is complete. And just really kind of spell out in high level terms what you expect to deliver and the timeline associated with that so that it all rolls up into that exclusivity period of that 90 to 120 days that the seller's given you as the buyer. The other one is seller covenants. So the seller covenants essentially means I, as a seller, promise that I will do these things. So either they could be positive covenants where I'm agreeing to do something, or they could be negative covenants where I'm agreeing not to do something. Okay, and so in this situation, the seller, I would say the first one is continuing to operate the business in a normal course of events. So meaning they're not going to change the strategy in any way. They're not going to hire and fire any key staff without you knowing. the second one that's very common is, making sure that there's no key business decisions that they do make, that they have to make because of just, day-to-day business, that are run by you as the buyer, because you now have an option to close on that deal, and you don't want them to substantially change the business or make changes to the employees or the customer base without your knowledge and you being part of that decision-making process. So you can spell in your offer that, listen, even though I'm not preventing you from running your business, if you have to buy a piece of equipment that's over $50,000, or if you have to fire or hire someone, just make sure that, I'm aware of it and that we mutually agree to that decision as we go down the process of you selling your business to me. Okay. Another one, this is a biggie, very big one. Make sure that you define upfront in your LOI what the non-compete expectations are for that seller. Oftentimes sellers forget that there is going to be a non-compete, and they don't really understand what a non-compete means in terms of the limitations and the time involved. And oftentimes sellers, they're really excited to sell their business, they're excited to retire, but at the same time, they kind of want to still be related to the space. And the importance of that is that, even though maybe their only skill is that business that they've built up and are now selling to you, well, the reality is they can't go and do that somewhere else. They can work with you if you want them around, but if you don't want them around, they can't go to a competitor of yours and help that competitor, because that would be against the non-compete. So very important that this is another contentious issue. Best to put it in the LOI up front and define what the term of the non-compete is in terms of the number of years that they're limited, and define the exact industry and geography region that non-compete applies to. So if it's a national business, it'd be the nation as a whole. So if it's a Canadian, so if I have them selling a business, even though it may be based in Toronto, but the business sells to customers across Canada, then you may limit the business and that seller from a non-compete for all of Canada. But if the business is very localized and it only really sells within a 2-hour radius, maybe you set the non-compete to only Ontario only. And that way, if the seller really feels like they're so inclined to get back into the sector, they won't compromise their value because they can't come into Ontario, but maybe they go all the way to Western Canada and do something in British Columbia. So it depends, right? But, each situation is different. Best to consult your lawyer, but very important that you should put this up front. And then lastly, as I mentioned in the mistakes section, make sure that you include an exclusivity period, define it well, and set the term so that everyone is clear on what exclusivity means and how long it will last, okay? So let's look at a live example here of a letter of intent. That this is actually the template we would use in our transactions and is also available on the website for purchase if you were interested. And then there's also a similar template for the purchase of assets of a business if that is relevant for your transaction. But really, this is a 6-7 page document that goes into enough detail to really make sure that you have a targeted LOI that addresses a lot of the key diligence points up front and will hopefully manage the seller's expectations. So we'll go section by section, explain what each section means, and that will tie in ultimately into a proper letter of intent. So the first section and these first two sections address, who is buying what. So the purchaser is really the acquisition company and who are the people behind that acquisition company. The vendors would be the sellers themselves, so the shareholders of that selling company, the company itself that is being acquired. And then in the transaction section, it defines really the target structure. So are you buying 100% of the shares? Are you buying 80%? Whatever the case may be. And so outside of just the shares, because when you buy shares, you're buying everything that comes with that legal entity, what is being excluded as part of the price? And that is what would be defined in this lower part of this section. So the purchase price will exclude specific personal assets that are held in the company, including personal art, personal car, a boat, whatever the case is. But you just want to make sure that that's defined up front so the vendor understands that outside of what is specifically defined and excluded in the LOI, all other assets are coming with the business. In terms of currency, we're Canadian, so obviously we have Canadian dollars. If you wanted to change it, it could be US dollars. And then here's the purchase price. So the purchase price is for all of 100% of the shares of the business. And the assumption is, and I would say 99% of our transactions, it's on a cash-free, debt-free basis, meaning the purchase price is assuming a normal level of working capital, but any excess cash or third-party debt is settled prior to closing. And so the price is subject to the key terms, which are cash-free, debt-free, any related party accounts. So that could be accounts, owing or, related and receivable from a related party, any shareholder loans, and any other types of debts. So that from a financing point of view, outside of just the working capital that comes with the purchase price, there's nothing else that is included in that purchase price. And so in this example, instead of really defining the EBITDA benchmark and the EBITDA multiple, you can present it in certain different ways. So you could actually change this section and use a multiple of X based on an EBITDA of Y. Or in this example, you could provide and manage the seller's expectations by saying, hey, we've relied on the information to date that you've provided, and based on the information you've provided, we believe that the normalized EBITDA is X for the last year, and then Y for this TTM period running up to the transaction close. And so even though there may not be a multiple, the benchmark at least is sets and defines relatively the valuation of the business. And in this example, instead of one single multiple, maybe you're taking an average of these two periods, and hence, it's a multiple of the average instead of a multiple of just the TTM. So you don't always have to include the multiple, but definitely the benchmark, because the benchmark is the core baseline assumption that you want to confirm during due diligence. So if there's ever a situation where you go through the QOV process and the EBITDA actually comes back lower than expected, you can go back to the offer and say, well, hey, listen, I relied and believed that your EBITDA was, $1 million. It's now come back 800,000. That's why I'm changing my offer, and this is my proposed new offer. And then for best practices' sake, I also think that it's important to define what EBITDA is. So normalized EBITDA is the earnings before interest, taxes, depreciation, amortization, adjusted for any extraordinary one-time expenses, and it will include an adjustment for any expenses or revenues that have not been recorded in the financial statements at their fair market value, and any adjustments that may come up during the buyer's due diligence. So that gives you an out from a buyer point of view to say, well, maybe you underestimated the potential IT costs in the business and you need to make an adjustment to the IT systems. Well, that could be an adjustment that you make. Whether the seller is accepting of that or not is a separate discussion, but at least this way, if there are other things that come up in diligence that need to be normalized, you have the ability to go back to this definition to say, well, the normalized EBITDA that I'm going to confirm during diligence, all these other things came up in the process. So from a seller financing point of view, we talked about the different, sources of seller financing. There's the equity, which is this section over here. There's the vendor note, and then there's the earn out, which is down here. So I've included all three sections in the wording that we usually see, just to make it easier. Obviously, not every transaction is going to have all three. Sometimes it's just cash and a note. Sometimes it's cash, equity, and a note. It depends on the situation. But when it comes to the note, I find it's really important you need to define the security and terms, define the key terms in terms of the length of the note, how interest and principal payments are being made, and any other obligations that the seller may need to rely on. So in this situation, the X amount of dollars of the purchase price will be satisfied by the VTB note. I would say for most of our transactions and for most of the banks prefer to see an interest-only note. That way it's deferred to theirs, and the priority is to pay down the bank first before the seller note. So it would be interest-only, and usually we see a single bullet payment after 3 to 5 years, with an annual rate in that prime-ish range. So today, prime is about 6.5%. So we're usually seeing notes in the 6 to 7%. A couple years ago, it was probably closer to 5. So we were seeing notes in the 5 to 6% range. So it depends on the timing of the marketplace, but prime is a relatively good target. And then ultimately, the ability to differentiate yourself in your offer is another. So if you really wanted to stand out and give the seller more income and make the note more attractive, maybe because you're asking for a bigger note, maybe you give them 10% or 12% earnings, and that usually will beat what they would generate in the marketplace. And so you could even position it with the seller to say, hey, listen, Mr. Seller or Mrs. Seller, even though I'm asking you to carry more seller financing than maybe the other person at the table, I'm guaranteeing that you're going to get 12% interest on this note, which is better than what you probably could generate anyways if you got the cash and put it into the stock market. So there's different ways to kind of pull the levers to stand out from positioning your note point of view. Now, it's very important. This is where it really starts to get a little tricky for the seller who maybe has never done this and is doing this for the first time. There's a general security agreement providing an interest in the assets of the purchaser and the company. So the note will be secured against the company moving forward. So that gives them the protection, but the security interest of that note will be subordinated to the purchaser's primary bank. So if it's a $10 million deal and there's $6 million in bank debt and $2 million in seller financing, then really that $2 million is behind the $6 million. And sometimes sellers when they hear that and they actually put one and one together and they understand that, oh, you're going to be subordinate to all that debt, all of a sudden they question the credibility and the security of that note. So sometimes what ends up happening, and I would say this is less common, but sometimes if you really want the deal as a buyer, you can offer up a personal guarantee. So the purchaser will provide a limited personal guarantee of X relative to the total note size as additional security for the VTB note. And usually that could be 25% of the note value, 50% of the note value. Usually you want to cap it. You don't want an unlimited personal guarantee. And a full guarantee of all the seller financing is also unreasonable. I would say, half and half is probably a pretty middle ground. And maybe you just put up 10% or 25%. But the concept of a personal guarantee is a great next step, negotiating step, if the seller starts to push back on the security of the VTB. Now, moving on to the equity section. So in this section, assuming you wanted to give the seller some equity, the X amount of dollars of the purchase price will be satisfied by the issuance of equity in the purchaser on a tax-deferred basis. And you really want to define, well, how much of the dollar value of equity that's given to the seller on an ongoing basis, what does that represent moving forward in the percentage of the business? And the reason I say that is there's two types of equity investment as in the form of a purchase price. There's a rolled equity versus reinvested equity. So rolled equity is, say, for example, let's take a $10 million deal. You want to buy 100% of the business and give 20% of the business to the seller. Well, if the seller is rolling 20%, well, really it's 20% of the $10 million purchase price, or $2 million would be the value here, and 20% would be the value here. Now, that is less favorable for the seller because really they're not getting the advantage and the benefit of any sort of leverage that you may be putting on the books. Because, say, for example, in that $10 million deal, you use $6 million in financing. Well, you've used $6 million in financing, the seller's rolled 2, and you've put in an additional 2 to get to that 10. But the seller is putting in a full $2 million for 20% of the business, while you're putting in $2 million for 80% of the business. So the common share value is unequal. And so I would say we've never done a deal where equity's rolled, to be honest, because it's unfair. So we push as a sell-side advisor and really encourage buyers to treat sellers on equal terms when it comes to equity and do a reinvested equity. And so what that means is on that same $10 million deal, if there's $6 million in bank debt and there's no other seller financing, it's just the debt and then the equity itself, well, net of the $6 million, there's $4 million equity remaining in that business. And if the seller wants to own 20% of the business moving forward, you then write a check for 20% of the net equity left after the bank debt and any sort of seller financing, or 20% of $4 million, $800,000. So there's a big difference between rolling $2 million or reinvesting $800,000 to get to that 20%. So it's very important not only to define the value, but also what the equivalent percentage is of that value as well, and explain to the seller what they're getting into. Because sometimes I've seen situations where advisors get involved later on. They see that the buyer is trying to pull a fast one on the seller and do a rolled equity, and they start pushing back and explain to the seller, and all of a sudden that creates tension later on in the process, which can maybe put your deal at risk. So it's really important that you define that up front. Now, as well, in every equity deal, we always strongly encourage that you have the ability to exit that equity position. You don't want to be in an indefinite minority position as a seller, because then you're in a perpetually discounted position. Who's going to step into your shoes outside of the buyer that's going to buy your business? And you're beholden to their timeline. And the reality is, even though sellers may be open to reinvesting alongside you, your timeline as a new buyer coming into the sector versus their timeline are mostly always going to be different. So what we always encourage in equity situations is to put in a put option. And so in this section, as part of the shareholder agreement, the vendor will have a discretionary put option available in the shareholder agreement to sell his or her shares in the company back to the purchaser on the blah anniversary of the transaction closing. So what that means is that the seller has the option to trigger the buyout of their shares years after the deal closes, after the transition period, and the equity has hopefully resulted in an increased value. And that means there's a defined off-ramp, but it's an option. So if they really like working with you as a new buyer, then they probably won't exercise the option, and then it goes away and there's nothing else. But if, say, for example, after 5 years, they're like, you know what, great, business is going great, but I just want to kind of hang up the cleats and just retire and move on, well, then the put option gives them that certainty and that comfort, which makes it easier to sell the equity. Because sometimes sellers are like, well, I don't really want to hold equity. But the buyer wants the seller to hold equity to really feel that true skin in the game, and to have that alignment and to share the future wins. So the put option is a great way to create some sort of term around that equity, so it doesn't feel like it's perpetual, like you're stuck in a situation where you're the minority shareholder. And so whenever there's a put option, obviously when you trigger that, there's typically a 90-day period in which there's a certified business valuator that would come in, value the business, and then the proportional equity of that business would therefore be bought from the seller by the buyer, and within X amount of days. It depends on, it could be 180 days, so you could trigger it and it would be a half a year process, or sometimes it's trigger it and pay me out in 30 days. So that's more specific to the purchase and sale agreement, less so in the LOI. But the high level concept of what value of equity, what the equivalent percentage is, and the put option are critical when you're putting in equity into the LOI. Okay, so moving on to the earnout. So in the earnout, same thing, X amount of dollars of the purchase price will be in the form of a contingent performance-based earnout. And so earnouts, very rarely do we see a 1-year earnout, because a 1-year earnout, it's almost like an all or nothing. We typically advise our clients to at least have 2 years, if not 3 years, to give them the ability to earn that earnout over multiple years, so that maybe if there's one down year and there's a strong year, at least you earn half of the earnout instead of lose it all in one full shot. But sometimes, we've done deals where it's a 1-year earnout, but rarely so. Most of the times it's 2 or 3 years. So, you want to define, well, how is the earnout paid? Is it in one full shot? Is it equally paid out in 2 years? Is, 1/4 of the earnout value paid in the year 1, and then 3/4 is paid in year 2? What are the targets in the earnout? Is it based on sales, gross margin, EBITDA? It could also be tied to employee retention. Maybe you do half, where half of the earnout is tied to maintaining X amount of sales over the next 3 years, and then half of the earnout is tied to maintaining these 5 key staff that we've identified for the next 3 years as well. So there's different ways you can cut up the earnout. Like, earnouts are pretty creative, and there's a separate video on the channel if you want to get into that, where I go into a lot of detail on that. But ultimately, you want to make sure that you're clearly defining the performance-based nature of this earnout. You're defining what the expectations are and how the payments work over the next 1, 2, or 3 years. Sometimes sellers are confused by this, so it's important to really walk them through a base case, a good case, and a down case, so they understand the repercussions of if they're overpromising or if performance does turn, what they're really at risk of losing. Okay, and then just this last section here, any earnout payment will be made within X amount of days of the final financial statement. So typically you want to make sure that any financials that you're basing an earnout on are subject to a third-party approval. So usually the accountant is preparing these numbers so that there's third-party sign-off, and it's typically anywhere from, I would say, 60 to 120 days is after you've received those financials, you then pay out the earnout. Okay. Now there are a couple other sections that we'd like to include from a seller protection point of view in the earnout section here. As a buyer, whether you include this or not depends on the quality of the sell-side advisor, and I would say your willingness to kind of be more middle of the ground versus kind of be a little bit more aggressive. But one section we try to really do is we want to put teeth to the timing of the payment of the earnout. So say, for example, the year-end financials are done, the accountant signs off and prepares the final numbers, and the earnout's based on sales. So you have the sales information there, and now you have 90 days to pay that earnout. But say, for example, there's a delay in payment and the buyer starts to drag their feet and doesn't want to pay that earnout within 90 days. Well, we always encourage that there's some sort of delayed payment interest penalty on anything beyond the expected term. So after 90 days, maybe it's prime plus 2% or it's 12% or whatever the case is. But that way there's teeth, and it encourages for the seller to think, hey, listen, yes, you are extending financing and there is risk of that financing, but you're also getting paid to wait if there's a situation where they start to mess around with your money. And there's still protections in place in terms of standard GSA that is subordinated to the senior bank financing. So no different than the VTB, there'd be security in the earnout in the form of a GSA charge on the business. And then lastly, there could be a covenant on if there's any outstanding earnout payment, no dividends or excess bonuses would be paid to the shareholders of that company to prevent the situation where, say for example, they're dragging their feet, but they ultimately pay a huge cash dividend to the current shareholders, the new owners, to take out all the money out of the company and essentially make the seller feel like they're being cheated out of their money. So there's different things to address, but the more protections you can include in the earnout section, I think the most contentious areas of the LOI are going to be the working capital and the earnout sections. Those are the two toughest areas, and some buyers swear that they'll never put in an earnout because of just how easy it is to start a dispute here. But so expectations management, and the more detailed you are here, I find is better when you get to the legals because you've already addressed these issues and talked the seller through them, so they're not mentally locked into it. This section, the payment of purchase price, ultimately just spells out the payment of the price. So if it's a $10 million deal, how much in cash do you get? How much in seller financing are you providing in terms of a VTB, an earnout, an equity, and what's the net cash? And what type of debt is coming onto the books versus buyer equity? So that way, once you fill in all these sections, especially the sell-side advisor and the accountant and the sell-side team can really comment on the viability of your offer in terms of how much cash is coming in, but as well how you're affording the cash down payment, what's coming from equity versus what's coming from debt. So we like to see that detail because that gives us a lot more comfort from the sell side to commit to one buyer versus another. Okay. So the next section, as I mentioned, is working capital. This is, again, another one of the contentious areas. I find that if you can negotiate net working capital earlier in the deal process, you avoid a lot of headaches for both sides. And it's partly expectations management from the seller side because sellers are notorious for being very poor net working capital negotiators and trying to get as much of their money outside of the business as possible, whereas we have to help them understand that it's market to actually leave a certain level of working capital behind to help fund the ongoing operations of the business. So there's a certain level of reasonableness from both sides that sometimes one side is a little bit more aggressive than the other. But ultimately at the LOI stage, sometimes we've actually defined the target right away and actually put the number from now. Whereas other times, you want to get into diligence and really understand that working capital target. So it's better just to define your methodology and the accounts that you want to include into working capital. So that way it's easier to avoid a situation where, WIP isn't part of working capital. That's separate outside of working capital. So you don't want to get to that point where what is working capital is a question. You want to define that up front as part of your purchase price, as part of your LOI, so that is being taken off the table for when you actually finalize a working capital target. So in this section, the first paragraph here is just essentially defining that the purchase price was going to come with a normal level of working capital, which is the target net working capital. Now, if actual working capital on the day of closing is less than the target, then the purchase price will be reduced dollar for dollar by the amount of difference between the actual minus the target working capital. Versus on the flip side, if there's excess working capital above the target, then the excess amount above the target is paid on top of the purchase price and is an increase to the purchase price. Okay? This next section here defines what is in working capital. So it includes accounts receivable, WIP, inventory, prepaid expenses, accounts payable, HST liabilities, whatever the case is. HST is a Canadian term for harmonized sales tax. But you also want to make sure that up front, and this is more a comment for buyers, that you also make sure that you define that historical net working capital shall exclude any unsold inventory that's very old, maybe older than 2 years, and any uncollectible accounts. So oftentimes one of the most common areas of negotiation for working capital is that the seller has a very old inventory that they believe has real value versus the buyer does not want to value that inventory because it hasn't been sold in years, and therefore there's that dispute there. So what we typically advise is that put the wording in that you won't consider inventory older than 24 months if there's a valid reason, but as well that the company can reimburse the vendor for the historical cost of any older inventory that does eventually sell. So that way the vendor does feel protected that sure, yes, I'm agreeing to zero value for that very old 20-year stock, but if it ever does sell, I then recoup the historical cost I put into it, so I'm able to recoup the cash that I tied up in that inventory. So that's a fair middle ground for working capital. And if you do that, I think that most of the time sellers, the challenge here is that if you don't put this language in, then you go down the process and you don't address old inventory until the final 30 days, and their lawyer's going to read over the purchase and sale agreement and uncover, hey, you're agreeing to valuing your old inventory at $0, and then all of a sudden this was like, whoa, no, I never said that. When did we agree to that? Versus you address it now, you make it less of an issue if you bring it to the forefront earlier on in the process. Okay. Now, in a situation where there are gift cards or there's deferred revenue and deposits that come with future jobs that are being booked into the pipeline, we always include an unused customer deposit section, which essentially means that any future earnings where you've received deposits and haven't used those deposits to deliver that future service and or product that you've sold, then 100% of that cash gets left behind, because that's a true liability. You're promising to deliver something in future and your customer has already prepaid you for that. So leaving that cash behind is really the future historical cost and margin that will be with that job. So we leave those behind. So make sure that you define, if this is a business where there are gift cards or deposits, that anything that's unused is not included in the net working capital, but is excluded from the net working capital and separately addressed as a liability and posted fully 100% with cash value. Okay. Now, the methodology, I would say, for most companies when it comes to determining the net working capital target is taking the last 12-month average, the monthly balance sheet, and looking at whatever accounts that were included as part of the defined net working capital of that business, excluding anything that may need to be excluded, whether it's bad debts or inflated inventory for non-recurring reasons, and really focusing in on the normal level of working capital in that business over the last 12 months. And that average is usually the target. Now, if the business is growing very quickly, maybe you consider shortening that average to 6 months. If the business is declining and the buyer is buying it off of the last over a multi-year period, then maybe you take a multi-year average instead of a 12-month average. So sometimes it differs, but I would say in the vast majority of our transactions, a 12-month average ideally captures the required level of working capital in that business. And then typically what ends up happening is that, so you set the target, you agree to it in closing while you agree to the methodology at the LOI stage. And then once that target is agreed to in due diligence and you close 90 days or sometimes 120 days after the closing, the purchaser will prepare the closing balance sheet, give that to the seller to review. They will agree that the balance sheet was prepared right, and therefore the calculation based on that balance sheet is then run. And then if there's an excess or a deficit, that gets corrected. And then lastly, these sections are detailed because, as I mentioned, these are the most contentious areas of the LOI. If there's ever a situation where there are outstanding tax rebates, income tax rebates associated with previous periods for working capital and for M&A transactions in general, the seller up to the day of closing is responsible for all income tax obligations. So if there's a receivable and or a payable, they own that, versus anything after that date, the income associated with the new ownership group, therefore they're going to pay their own income tax. But up to the date of closing, the vendor that is selling that business own that income, and therefore they are going to pay the income tax associated with that income. But if there's ever a dispute in that situation, then you want to make sure that you have a third party, unbiased third party that you guys can go to have an arbitration and therefore negotiate a settlement. And we usually want to make sure that we define up front that any cost for an external third party arbitrator that gets involved in a dispute is split 50-50 between the vendors and purchasers, so that there's equal teeth when it comes to, okay, if you really want to make this a serious issue and take this to a third party, you're going to have to incur some costs as well. So then it's split equally. Okay. So moving on to the next section. So certain businesses may have own their real estate, versus other businesses may lease their real estate. So in a situation where the business owns the real estate and you want to buy the real estate, great. Then it's a really simple section. You're just really, because really the LOI is more of addressing the business acquisition while also setting the assumptions around the real estate. So if you wanted to buy the real estate, you define the address of the property that you're buying that is owned by the separate real estate holding company that owns that real estate, and you would just specify the purchase price for that real estate. And obviously, like most real estate transactions, there very rarely is seller financing on the real estate portion of the transaction. Most of the seller financing is related to the business acquisition side. So, unless there is really seller financing that you're also applying to the real estate, then you may want to put some additional wording here. But if not, and you're just buying the real estate for cash, then that's all you really need to include at the LOI stage. Don't overcomplicate the real estate. But say, for example, the business leases the real estate. In that situation, then you really want to make sure that you define the terms of your commercial agreement up front. If the business leases the real estate and there is a third-party lease where you're not dealing with the landlord, then you're going to assume whatever the lease is. But if you are leasing the property from the seller of the business as well, and the seller has chosen to continue to own the real estate, then you are now also negotiating the terms of your lease on an ongoing basis with that same seller. So you don't want to defer this conversation to later on in the process, because part of your valuation is based on the terms that you're going to get in your real estate agreement with that seller. So you want to make sure that you tie your business offer to the real estate negotiation and say, hey, I'll give you X amount of dollars and here's my price on the business, but that's subject to the terms that I expect to receive on the real estate side, which is subject to discussion with the seller. So typically we see triple net leases, meaning that all of the costs are passed on to the buyer on an ongoing basis. So TMI, property taxes, insurance, and everything, plus base rent is covered by the tenant, and then really the owner just covers the more structural related costs of ownership of that real estate and any major renovation expenses. But I would say the average deal that we see is usually a 5+5 lease, meaning it's a 5-year initial term lease with a 5-year extension. Other times we've seen 3+3+3, and other times we've seen 5+5+5. So in this example, I've assumed a 5-year triple net lease with an option to renew for another 2 5-year periods. So that's a 5+5+5. And then we've defined here that based on the facility, based on this real estate that I want to lease for the next 5 years, I have a $10.50 a square foot plus TMI for the triple net. And there's an annual escalator to compensate the owner of the property for CPI and ongoing inflation in the real estate market for the term of the initial lease. Any renewals after that is then separately negotiated at the time of the renewal based on current market rates at the time. So we very rarely negotiate a 20-year lease. Oftentimes we try to keep these leases shorter because from the business buyer's point of view, you don't know if you really need this property moving forward. If this is a business where a lot of the assets are the property itself, then A, you either have to buy the property itself, or B, you're going to be in there for a really long time and maybe you shoot for a longer lease. But most home service contractors, professional service type businesses or manufacturing entities, we typically go for, 5+5+5, which, the initial term of the lease, there is a defined, $10.50 a square foot or whatever the cost is, and any ongoing renewals, the rate will then be reset at the time. And then the last thing we typically recommend buyers include is that you want to make sure you have a right of first offer. And what that means is essentially you have the first kick of the can if there's ever a situation where that seller decides to sell that property. The seller has to notify you that, hey, I want to sell the property. Here's what I want to list the property at. You have 30 days to decide whether you want to buy the property before I take it to the open marketplace. That way you have an exclusive first right on the property. But if you choose, say, for example, to pass on it and say, I'm not ready to buy the property, then the seller is free and clear to do what they want with it and to list it on the marketplace and sell it. But that way it protects you in a situation where if you want to own that property in the future, the seller has to come to you first and give you that first crack at the nut. Okay? The next section is the vendor consulting agreement. So again, these are another key point in the negotiation process. How long do you want the vendor to stay on? Are they going to be a consultant or an employee? And I warn you that in most situations, if there's an employee, if they are an employee on an ongoing basis, just consult the severance liabilities that are associated with keeping the seller on as an employee, versus if they're a consultant, they're foregoing all their severance liabilities because they're really signing on as a consultant moving forward. And it's easier for you to terminate that employee. The rights and rules around a consulting termination versus an employee termination are very different. And so legally, it's easier for you as the buyer to put the seller on a consulting agreement with no benefits and just a straight annual prorated salary. And that's what we typically define here. So you want to make sure that, say for example, the EBITDA was normalized for $150,000 for the role of the owner, then do you give them $150,000 for their ongoing contribution during that year, or do you give them a little bit less? Typically, we see whatever we normalize the EBITDA for the owner's role is usually the pro rata salary rate that we use here, and then it's pro rata based on the number of hours worked. So usually the seller maybe wants to sell and then only work 4 days a week. So even though the annual rate is $100,000, it's prorated based on 4 out of 5 days per week. So the actual amount that's paid out on a monthly basis is less. And then lastly, you just really want to define the minimum work hours that you expect the seller to work. And again, this all goes back down to expectations management. You want to make sure that the seller clearly understands how are they going to be working in the business, what do you expect out of them, what are their main responsibilities, what does that term look like, and clearly manage their expectations, okay? So moving on to the conditions of closing. So this is another important section. This ultimately defines what are the things that you need to do to get done in order to close this transaction. So the first is more a broad closing condition. You need to complete your legal, tax, and financial due diligence and make sure that all of the information that you are asking for is provided so that you can feel comfortable in closing. If there are situations where you need to obtain any consents from customers, suppliers, or regulatory bodies, then those consents need to be accepted and approved so that you have them when you close. If the purchaser is buying the property, then you're buying the property, or if you're entering into a lease, then you agree to a lease. But ultimately what this condition does is it ties your offer and your closing process on the business side with you ensuring that you've also agreed to terms on the real estate side, because you'd never want to buy a business but not agree to terms on the real estate side. So both close at the same time, and therefore they become a condition of closing. You also want to make sure that any offers of employment for key staff are provided, agreed to, communicated with to staff, and signed off on, so that you make sure that those key staff are staying on prior to closing the transaction. And make sure that the shareholders of the company are signing a confidentiality, non-compete, and non-solicit agreement. This is very important. As I mentioned earlier in the video, non-competes are a tricky area where sometimes sellers are pushed back to they want to keep that door open for maybe I have the energy to do something a little bit smaller in my space, but at the end of the day, you're trying to buy a business and protect that business's value, so you need to have certain protections in place. So a key condition of closing is making sure that the non-compete is agreed to, and the terms of those non-compete are, funny enough, addressed later on here, so we address that in the LOI as well. This section as well, it comes with the material adverse change. So if there is a significant change between the LOI date and the closing date, you can point to this and say, hey, there was a material adverse change. Even though you provided all the diligence and everything came back, now that there's been a significant change in the marketplace, I am choosing to withdraw my offer. So that's really kind of your exit door in a black swan event or a situation where conditions really change and go back. The next section is exclusivity. So here, as I mentioned, one of the common mistakes is not defining exclusivity. So we clearly define what exclusivity is and the term of that exclusivity. So we set a term of 120 days or 90 days. Usually it's that 90 to 120 day term on average. And then as well, define and manage the expectations of the closing process. So what are the key milestones that the seller has to do and work towards to really get to that closing? So usually it starts with operational and financial diligence. Those are usually the first two sections. So operational are site visits, meeting with the owner, understanding how the business works, how customers order, sales, quoting, bidding, all that kind of stuff. There's also the quality of earnings for the financial side, so confirming the quality of the financials and the EBITDA that you're basing your valuation on. So those are maybe get delivered in the first 45 to 60 days. Then there may be a third-party environmental report if you're buying the property, or you want to make sure that the quality of the environmental condition of the property basically is up to par, and that you have a baseline report that you can refer back to. You want to finalize the net working capital target within 60 days. You then want to, and then you move towards closing. So typically it's operational, legal, more real estate related, and then it moves into the final stage of the closing process, which is more the legal side. And so that's why typically the legal share purchase, real estate purchase, and shareholder agreement, if there is one, get addressed 90 days after. And that at that point in time, as you're incurring more and more costs as the buyer, that's when there's real skin in the game from your side as well. And that's when typically the seller feels that, okay, you've gotten the legal documents done or substantially done, you've gotten your bank financing approved, you've completed all your diligence, the QOVs come back okay, we are really on the 1 yard line here. Therefore, I'm now comfortable. And the last one is I'm now comfortable in letting you talk to my key staff or customers to gain the necessary consents to close a transaction ultimately. But this way, when you break it down this way, everyone can manage the seller's expectations more effectively because the seller can visualize closing. Oftentimes, our clients have no idea what closing means. Everyone says closing, but what is closing? What do you do first? Where do you focus first? Where should I focus my efforts and make sure that I'm pushing to meet these milestones? And so the more detail you can have here, I find is generally better from an expectations management point of view. Now, the one out here, and this is what I usually recommend for our clients on the sell side, is if you are unable to meet those milestones, the vendor has the exclusive right to walk away and break that exclusivity period because you're jerking my chain. We can't agree to a net working capital target. You're dragging your feet. You don't want to incur the costs. Well, then fine, we're walking away from this because, why am I going to sit in exclusivity and waste another 30 days when you're not making the necessary efforts to get this deal advanced and closed? So that there's some skin, there's some teeth into this section here because it gives the vendor, the seller, the ability to exit the relationship if the buyer is not keeping track and pursuing the milestones in a timely manner. These last couple sections here are more boilerplate, but ultimately on the taxation side, you just want to make sure that from a tax point of view, everyone has the ability to make the necessary tax changes to comply with the tax code. The announcement section means that without the consent of the purchaser, and the vendor is not allowed to disclose anything, or their advisors, such as their investment bankers, are not able to publicly announce any sale without the consent of the owners moving forward. And then this section here is a key one, is the confidentiality and non-compete section. So you want to clearly define that the vendors and any other related family members currently working in the business will enter into a confidentiality, non-compete, and non-solicit agreement, meaning the non-solicit is you can't go after current employees, key staff, after you've left the business to try to recruit away key staff from the business. And you want to define the term of that, which is usually 5 years. The shortest I've seen is about 3, and oftentimes it can even go up to 10. Not oftentimes, but every now and then when there's a key business and it's a younger seller, maybe you keep it longer as the buyer to protect that against that younger seller coming back to go after your business. And then you want to define the specific industry that it's in. So if it's in food manufacturing or if it's in precision metal manufacturing, and then also the province, state, and or region that you're in. So if it's a national business, then maybe it's Canada as a whole, or if it's a very local business, maybe it's the province of Ontario as a whole. Okay. And then the last sections here are you want to make sure that the expenses are, each group is covering their own expenses. So the vendor pays for their own legal fees, their own diligence costs, and vice versa. The purchaser will cover their own diligence costs. So there's no confusion around, well, the Q of V, who's paying for that? It's always the purchaser. And if the purchaser is requiring an environmental report, then they as well have to pay for that environmental report. And then here, in terms of the good faith negotiation, so you want to make sure that you can terminate the LOI and move towards a definitive purchase agreement, meaning that you shift this signed document over to the next document to move towards a closing. And then this is where you define the closing date. So here, usually if it's a 120-day exclusivity period, then 120 days later, this is the date you'd probably put in there between when you sign the LOI and you want to close. And this way you define really the final drop dead. This is when we're pushing towards closing. And I would say in most cases, we usually get under the closing date. But oftentimes, you'll sometimes see the delays in banking or a delay in quality of earnings that results in us running longer and ultimately requiring a 30-day extension to the LOI to then ultimately get the transaction closed. So it all depends on the situation. And then this is the termination section. So this means that it gives the right for the purchaser to terminate the LOI at any date prior to the expiration of the exclusivity period, but not the seller. So once the seller signs, they're now committed and exclusive with that buyer for the term of the exclusivity period. But say, for example, the buyer uncovers something and they just want to let the seller go and release the exclusivity period, the purchaser, the buyer, has the ability to terminate the exclusivity period earlier. And this is what that section defines. And then lastly, authority, again, more legalese, boilerplate legalese, confirming that any of the vendors that are signing this document have the authority and ability to actually sell the company. So you want to make sure that you're dealing with the decision makers. And that's typically what I recommend here is that, say, for example, it's easy if it's one owner of a business, but if you, say, for example, are dealing with 10 shareholders and there's 2 that own 80% of the business and there's the remaining 8 that own 20% of the business, well, who do you actually get to sign the agreement? You could ask the 2 main guys to sign it, but then maybe you ask a third to sign as a proxy for the remaining 20%, or in a situation where there's 3 or 4, maybe you just put all of their names in the LOI and get them to all sign it. So it all depends on the situation, but make sure that if there are multiple shareholders are signing the LOI, and it's not just one person representing a group, because there may be misalignment, and that individual that's signing may say, yeah, oh yeah, I've talked it over, everyone's okay. But the reality is sometimes they may be mismanaging your expectations as a buyer. So force the seller to have all of their shareholders sign it if you can, and if it's logistically doable. Sometimes it's not, but most of the times it is. So that's it. That's really kind of the overview of the LOI template. This is just a small disclaimer to say that obviously I'm not a lawyer. I'm an investment banker. So I'm giving you guidance and consulting you, but ultimately you can take this final product, input your specific deal details, run that by a lawyer. That lawyer can spend 30 minutes reviewing this and checking, the quality of the information, but you're pretty much have a substantial finished product here that is detailed enough to manage the seller's expectations and be effective. And, funny enough, I just used this template on a recent deal that we closed, and we were working with a smaller local market lawyer, and they made the joke that this is borderline almost like a purchase and sale agreement, how detailed it is, and that most of their job was just, expanding on it, and there was very little negotiation. And I loved hearing that, because that's the truth. The reality is a really properly structured LOI that both the seller and buyer have talked through and understood clearly is going to speed up the closing process tremendously and reduce any potential deal failure situations. Okay? So hopefully you found the video helpful. If there's any other comments or questions that you have, please comment below, or you can reach out to me on LinkedIn and connect with me there. And if you are looking at a deal right now where you feel like you need some advice, you just need to kind of chat with someone, talk through the valuation process or how you're going to put an offer together, you can actually book a 1-hour consulting call with me. I'll put the link in the video description, and I'm more than happy to jump on that call with you and talk you through your transaction. So hopefully you found the video helpful, and have a wonderful day, guys. Thank you.